somewhere right now, a retail investor is about to make a decision that will either compound into six figures over the next 20 years, or quietly bleed their savings through fees they never noticed. The difference between those two outcomes usually isn't talent. It isn't luck. It's one thing: which fund they chose. There are over 4,000 ETFs trading on US exchanges right now. Most of them are noise. A handful of them are the actual engines that have built more new millionaires in the last decade than real estate, than gold, than almost anything else. Today, we're going to cut through that noise. By the end of this video, you'll know exactly which funds the data actually supports, why the ones everyone's chasing on social media usually aren't the right pick, and the exact framework professional allocators use to decide where their own money goes. This is not financial advice, it's financial education, and the distinction matters. We're going to show you how to think, not just what to buy. If you're ready to stop guessing with your money, let's get into it. To understand why we're even having this conversation, you need to understand the war that ETFs already won. For decades, the financial industry sold a simple story: pay a professional, and they'll beat the market for you. Mutual funds, hedge funds, your uncle's guy who knows stocks. That was the model. Then came the data. Year after year, studies, including Morningstar's own long-running research, have found that fewer than 5% of actively managed large-cap funds beat their passive index counterparts over a 15-year period. Not most years. Not even close to half. Under 5% over 15 years. That single statistic is why trillions of dollars have moved out of actively managed mutual funds and into exchange-traded funds, ETFs, over the past 2 decades. So what actually is an ETF, in plain English? Think of it as a basket. Instead of buying one company's stock and betting everything on that one business surviving and thriving, you buy a single share that represents a slice of hundreds, sometimes thousands, of companies at once. When you buy an S&P 500 ETF, you're not betting on Apple or Nvidia or Microsoft individually. You're betting on American business as a whole, continuing to grow the way it has for the past 100 years. And the cost to do this has collapsed. Some of the funds we're going to cover charge as little as 2 to 6 cents per year for every $100 invested. That's not a typo. The expense ratio war between Vanguard, Fidelity, Schwab, and BlackRock has made broad index investing almost free. This matters more than people realize. A fee that looks tiny, 1% versus 0.2%. Compounds into tens of thousands of dollars in lost growth over a 30-year investing horizon. We'll show you the math later in this video, and it might genuinely shock you. But here's the trap a lot of new investors fall into: they hear ETFs are great, open a brokerage app, and then freeze. Because there are thousands of them, they all have different tickers, different strategies, different risk levels, and Finance YouTube is screaming a different best ETF at them every single day. So in the next part, we're going to build you a map. Before we name a single ticker, you need this framework. Because the question, what's the best ETF, is incomplete. The real question is, best ETF for what? Professional allocators generally think about ETFs across 4 categories. Category 1, broad market core funds. These track the total US stock market or the S&P 500. Their job isn't to be exciting, it's to be the unshakable foundation of a portfolio. Most financial independence success stories are boring at their core, one or two broad funds, bought consistently for decades. Category 2, Growth and Tech-Tilted Funds. These lean into innovation-driven sectors, technology, AI infrastructure, semiconductors. Higher potential upside, but also sharper drawdowns when sentiment turns. These are accelerants, not foundations. Category 3, Dividend and Income Funds. Built for investors who want cash flow now, not just growth later, retirees, or anyone building a passive income stream. These funds tend to hold more mature, established companies with a track record of returning cash to shareholders. Category 4, Diversifiers, International, Bonds, and Real Estate. These exist to reduce how much your entire net worth depends on one country, one asset class, or one economic cycle. A genuinely well-built portfolio usually pulls from more than one of these categories, weighted according to your age, your goals, and how much volatility you can stomach without panic selling at the worst possible time, and that emotional discipline, by the way, matters more than which fund you pick. With that framework in place, let's go category by category and look at what the actual current data shows. We start here because, for most people watching this, broad market funds should make up the largest slice of their portfolio. This is the unglamorous backbone. The two most talked about names in this space are funds that track the S&P 500, the 500 largest publicly traded companies in America, and total market funds that go even further, including mid-cap and small-cap companies too. What the research consistently shows is this: the difference between the various S&P 500 ETFs from Vanguard, Schwab, State Street, and others is almost entirely down to cost. They all track the same index. The fund that wins long-term, statistically, tends to simply be whichever one charges the lowest expense ratio and tracks the index most precisely. As of the most recent data, some of these funds charge as little as 2 basis points annually. That's 2 cents for every $100 invested per year. State Street's newer S&P 500 ETF offering has positioned itself as one of the cheapest options in this category specifically to compete on that single metric. Total market funds, meanwhile, add thousands of additional smaller companies on top of the big 500. The historical return difference between S&P 500 only and total U.S. market has been modest over most multi-decade periods, but total market funds offer slightly broader diversification by definition. You own the up-and-coming companies too, not just the established giants. So which is a better? Here's the honest answer the finance industry often won't give you. For most long-term investors, this choice matters far less than two other decisions: how much you invest and how consistently you invest it. The S&P 500 versus total market debate is a rounding error compared to the difference between investing $200 a month starting at $25 versus starting at $35. That single chart should be reason enough to stop researching the perfect ETF for 6 more months and just start. Now, what about the rest of the world? We'll get to international diversification in Part 6. First, let's talk about the category everyone's most excited about: growth. This is the category that built fortunes over the last decade, and also the category that humbles overconfident investors the fastest. Growth-focused ETFs concentrate on companies expected to expand earnings and revenue faster than the broader market, historically dominated by technology, semiconductors, and now, increasingly, artificial intelligence infrastructure. One of the most widely discussed funds in this space tracks the 100 largest non-financial companies on the Nasdaq. According to recent industry data, this fund has delivered roughly a 459% total return over the trailing decade, with technology making up close to half of the entire portfolio, and major chip and AI infrastructure names sitting among its top holdings. That number, 459% over 10 years, is the kind of statistic that goes viral. But notice what it doesn't tell you. In the most recent stretch of 2026 alone, that same fund has shown a modest pullback, a reminder that concentrated growth exposure does not move in a straight line. The ride up was not linear, and the ride down won't be either. A second major growth fund applies a rules-based screen for companies with strong earnings growth, sales growth, and return on assets, casting a slightly wider net across exchanges, with one of the lowest expense ratios in the category. Recent data places its trailing one-year return in the low 20s%, with strong 5-year performance as well. A third option applies a more explicit earnings quality screen, resulting in a portfolio with somewhat more sector balance. Still tech-heavy, but with a slightly larger allocation to healthcare and financials, and inclusion of some less traditional growth names alongside the familiar megacap technology holdings. Here's the pattern across all three: extremely similar holdings, similar long-term direction, but meaningfully different concentration levels. The most concentrated fund will amplify your gains the most when technology is winning, and amplify your losses the most when it isn't. This is the category where the question, how much volatility can I actually stomach, emotionally, without making a panic decision, matters more than any back-tested return number. A fund that returns 30% in good years but causes you to sell in a 25% drawdown is, for you personally, a worse fund than a steadier one that returns 12%. That's not a cliché. That's the single biggest reason retail investors underperform the very funds they own, a phenomenon researchers call the behavior gap. Not everyone watching this is 25 and decades from retirement. Some of you are closer to the finish line, and growth alone isn't the goal anymore, cash flow is. That's where dividend-focused ETFs come in. These funds screen for companies with a track record of paying, and ideally growing, their dividend payments year after year. One widely held dividend ETF has now raised its payout every single year for 14 consecutive years, according to recent fund data. That kind of consistency is exactly what income-focused investors are looking for, not the highest possible yield, but the most reliable one. There's an important nuance here that beginners often miss: the highest-yielding dividend fund is rarely the best one. An unusually high yield is frequently a warning sign. It can mean the underlying stock price has fallen sharply, artificially inflating the yield percentage, or that the payout itself is at risk of being cut. Professional income investors generally prioritize dividend growth and payout sustainability over a headline yield number. There's also a newer category worth knowing about: monthly dividend ETFs, specifically built for lower volatility, designed for retirees who care less about maximizing total return and more about a steady, predictable check landing every single month rather than once a quarter. Whether dividend funds belong in your portfolio really comes down to one question: do you need this money to live on now, or are you still in the growth phase, where reinvesting everything matters more than receiving cash payouts? If you're decades from retirement, dividend funds can still play a role for stability, but they shouldn't crowd out growth exposure prematurely. Why? Here's a question almost nobody asks themselves: what happens to your entire portfolio if the United States, specifically, has a lost decade? It's happened before, in other countries. Japan's stock market took over 30 years to reclaim its previous all-time high. It can happen anywhere, including, eventually, here. That's the entire argument for international diversification. As of recent data, international equities have actually outpaced U.S. stocks for over a year now, a reminder that U.S. stocks always win is a recency bias, not a law of nature. Several actively managed international ETFs have earned top gold ratings from independent fund analysts recently, built around disciplined, valuation-focused approaches investing across dozens of global markets. The broader and simpler option, for most investors, is a low-cost international index fund that simply captures developed and emerging markets outside the U.S. in one purchase. Bonds play a different role entirely, not growth, but ballast. As an investor's time horizon shortens, target date and bond-focused ETFs gradually shift a portfolio's allocation from aggressive equity exposure toward more stable fixed income, smoothing out the ride precisely when stability matters most, right before you need the money. None of this is about predicting the next crash. It's about making sure that no single outcome, one country struggling, one sector crashing, one decade underperforming, can derail your entire financial future. Let's go back to that fee comparison we promised earlier, because this is where most new investors lose the most money without ever realizing it. Picture two identical investors. Both invest $500 a month for 30 years. Both happen to pick funds that earn an identical 8% average annual return before fees. The only difference: Investor A pays a 0.03% expense ratio. Investor B pays 1%. After 30 years, Investor A ends up with meaningfully more money, tens of thousands of dollars more, purely from that fee gap, even though their underlying investment performance was identical. That's not speculation. That's simple compounding math, and it's the single most controllable variable in this entire video. This is why, across every category we've covered today, broad market, growth, dividend, or international, expense ratio should always be one of the first numbers you check, right alongside what the fund actually holds. You cannot control what the stock market does next year. You absolutely can control what you pay to be in it. So where does this leave you? Not with a single best ETF, because that question was always the wrong one. It leaves you with a framework. Ask yourself 4 questions. 1. How many years until I actually need this money? Longer horizons can absorb more growth fund volatility. Shorter horizons need more stability. 2. How would I genuinely react if my portfolio dropped 30% in a month? Be honest. Your real answer determines how much growth-tilted, concentrated exposure you can responsibly hold. 3. Do I need income from this money now, or am I still in the building phase? That answer points you toward dividend funds or growth funds, respectively. 4. Am I overly concentrated in one country, one sector, or one company? If the honest answer is yes, that's your cue to add a diversifier. There is no universal best ETF to buy today. There is only the best ETF for your specific timeline, your specific temperament, and your specific goals, built from the categories we just walked through. What never changes, regardless of which funds you choose: start as early as possible, keep costs as low as possible, diversify intentionally, and stay invested through the inevitable downturns instead of reacting emotionally to them. That's not exciting advice. It also happens to be the advice that's actually worked for nearly a century of market history. If this video gave you a clearer way to think about your own investing decisions, that's exactly what this channel exists to do. Turn confusing financial topics into something genuinely useful and actionable. A reminder before you go, everything in this video is educational content, not personalized financial advice. Do your own research, consider speaking with a licensed financial advisor for your specific situation, and never invest money you can't afford to have tied up through a market downturn. If you found this valuable, the single biggest thing that helps this channel keep making videos like this is hitting subscribe and tapping that notification bell. We're publishing weekly breakdowns just like this one, covering everything from individual stock analysis to portfolio building strategy. And if there's a specific fund, sector, or investing topic you want broken down next, drop it in the comments below. The next video on this channel might be your idea. Thanks for watching Index and Grow. Investing made simple. Wealth made possible. See you in the next one.